This week was short of economic data, but geopolitics certainly filled the void. The week started on a promising note, with US Treasury Secretary Mnuchin telling a Sunday TV show that we are putting the trade war on hold. This boosted market sentiment, and any cooling of US-China trade tensions is welcomed by markets, and risk barometer Aussie yen started the week strongly. But good news has been harder to find since then. Firstly, on trade, the US is using the same national security rationale it cited for its steel and aluminium tariffs to potentially place new tariffs on imported vehicles and automotive parts. Remember as well, these steel and aluminium tariffs commence on the 1st of June for those countries not exempted. Closer to home, Chinese state media has threatened to punish Australia over political tensions by substituting imports of Australian beef and wine with US imports. RBA Governor Lowe this week delivered a speech discussing the deep economic links with China, which has been Australia's largest export destination for some time now. As Lowe discussed, too often this relationship is viewed through the prism of resource exports, but the growth in Australia's service exports is notable, particularly tourism and education. Given this, we can only hope the latest warnings do not end up causing damage to Australia's tourism on the scale of China's recent punishment of South Korea over their missile defence system. Emerging markets and European politics have also been a cause for concern, with Italy's new coalition leaders forming their cabinet plans and continue to include strong Eurosceptics as candidates for key posts. Turning to economics, the US FOMC minutes were the main event. While it seems like they are on track for another hike in June, there is clear reference to being nearer to the neutral, and they are happy with a temporary period of inflation modestly above 2%. This took some urgency out of the market's expected Fed profile and saw the US dollar and bond yields ease lower. Domestically, Q1 construction work was the only data release, showing a small 0.2% increase in the March quarter. The headline result fell short of expectations, but despite this, the construction sector will still potentially add to Q1 GDP, which is released on the 6th of June, and could be close to 3%, matching the RBA's ongoing optimism. Now, geopolitics again came to the fore, with news that the historic summit between Trump and North Korea's Kim would now be cancelled, as insults continued to be thrown between parties. This again has weighed on risk sentiment, with equities and risk-sensitive currencies falling. That is leaving the Aussie dollar in a delicate position. Commodity markets look well supported, domestic data has been okay, the RBA remains optimistic, and the US dollar appears more balanced following the FOMC minutes. This means the Australian dollar should find support under 75 cents. But if emerging markets and geopolitical strains accelerate, then rallies should be capped around 76.30. We look forward to talking to you next week.